Well, risk sentiment continued to improve last week, albeit the FX market and bond space took a little bit of a pause ahead of a monster week of risk events that we've got coming up this week. Key central bank decisions from the Fed, the Bank of England, the ECB, inflation figures from Europe, jobs numbers from the United States, PMIs across the board, and earnings from across the tech sector, as well as a whole host of other S&P 500 companies as well. Plenty to discuss on the trade-off this week with Ryan Littlestone. Without further ado, let's get into it. Well, as I said in the introduction, plenty to discuss this week. Without further ado, let's bring him in. Ryan, how are you doing?
Yeah, hi Michael, good weekend?
Yeah, not too bad, thanks, mate. Not too bad. Albeit Arsenal losing on Friday night didn't get it off to the best of starts, but it's going to be a busy week in the markets, so a nice restful one all round.
Yeah, nice quiet week, nothing much to go on this week. Only the three central banks, a ton of data, big economic data, NFPs, ISMs, jobless, GDPs. No, nice quiet week. We'll all go down the pub, I think.
Exactly that. I must say I'm looking forward to a bit of a lie down at the end of it. But let's crack on with Topical Thunder and get into those central bank decisions. So, as Ryan said, it's a huge week of central bank meetings this week. The Fed on Wednesday, followed by the Bank of England and the European Central Bank on Thursday. It's a bit unusual for me to be in this position, but I reckon the ECB is probably the easiest of those three central bank meetings to try and gauge. They're going to give us a 50 basis point hike. They're going to signal we're going to get another 50 in March, and on we all go to 6 weeks' time. I think, personally speaking, it's a little bit more difficult to gauge what the Fed and what the Bank of England are likely to do. Probably 25 from the Fed, probably 50 from the BoE. But I think the key thing I'll be looking for, I don't know about you, Ryan, from the Fed is, does the market finally buy into this higher for longer message that it's just been ignoring for so many months now?
I think that's where Powell's got his work cut out, getting that message across, because it's almost like he's given the market too much leash to go and do what it wants, and it's not working for them at the moment, or perhaps it is, depending on what they want to do. They're talking about these financial conditions. When you've got mortgage rates surging up to 7%, then you can think, well, maybe their hike path was getting some things a little bit too over cautious in those hike expectations. So maybe let these financial conditions loosen a little bit. Takes a bit of steam out where they saw pressure, but they've got to keep the message in play. And I agree with you what you say, that the Fed is probably the bigger game in town this week versus the ECB and maybe even the Bank of England.
Yeah, no, I would agree with that. I do want to just touch on the Bank of England, though, because I think the BoE have been incredibly reluctant, really, throughout this whole hiking cycle. We obviously had a three-way split on the MPC last time around. We've got two policymakers in December voting for rates to remain unchanged. And, I don't think it would be that much of a surprise if another policymaker or two actually joined that dovish camp.
Yeah, no, I agree. I think you're probably being a bit polite saying reluctant as opposed to useless.
We've got to try and be politically correct, haven't we?
Yeah. Well, we had 6 of them voting for 50 pip hike, so you've got to think they're going to be there or thereabouts. Maybe there's some that coming down to 25. So that way I think is maybe where we get a bit of action in terms of the votes and what the bank are thinking of going forward. We are expecting a 50, then to drop to a 25. But, again, it's about what are they going to do past their pause point, if you like. Is it a higher for longer? Or are they actually going to pause after one more hike from this one? And that's the end of the story for now.
Yeah, I mean, I think in many ways the BoE have almost been looking for a way to end the hiking cycle almost as soon as it began. And actually, the rather mental way that they try and signal policy through their longer run inflation forecasts based on market rate projections, that's really what we want to be looking at on Thursday lunchtime. How much of a downgrade do we get to the 1.5% end of 2024 forecast that it currently sits at? And if we do get get quite a chunky downgrade to that, then obviously that's a very, very dovish sign and bad news for the pound. But I know you wanted to discuss where the risks may lie and where any surprises might be as we go through these key decisions.
Yeah, exactly. As a trader, I always look at, we talk about what we expect central banks to do, the moves, where markets can go. But the first thing I always do is look at the risk. Where is the big price risk? Where can the biggest shock to markets happen? And that's from, obviously, the central bank's doing not what the market expects. So when you take the ECB, for example, you're talking at, we know we're getting 250s for the next two meetings, perhaps. What we don't know is, are we going to get a definitive 250s? Are there going to be a bit of dissent on pushing Lagarde's projections, if you like, for these rate meetings? Or are we going to get something a little bit more dovish? If it's more dovish, that's the big shock for the market for me. The same with the Fed. Everyone's expecting a 25, another 25, then a pause. Well, what if they, decide to pull the rug out from under the market, want to stamp down their authority on where rates are going, and they go a 50 this meeting, and then say, okay, we're going a 50 because you're getting yourself a little out of control in the dovish side. So we're just going to let you know what we're doing. Or indeed, they say, yeah, we may go 25 this month, but we also may go 25 for the next four meetings. Something that the market isn't really expecting. And that's what gives us the biggest move. And the same with the Bank of England. It's all going to be down to those votes. Who's going to change what? Is the voter for 75 pips going to stick with 75 or seem dovish and come down to a 50? Are we going to get more voting for unchanged? It's all to play for, as they say in football terms.
Most certainly. It all to play for West Ham as well this season, but we did promise that we weren't going to mention that. Out of all those that you mentioned, though, I think it's probably, for me at least, the Bank of England, actually, that have got the most potential to surprise, just because there's so much at play. I mean, the Fed have been resolute in this higher for longer message, and actually the vast majority of policymakers, at least those with a vote, have pretty much been singing from the same hymn sheet. The ECB seem remarkably united and remarkably determined to tighten financial conditions in the Eurozone. And it's really the BoE where all those risks are. What do we get in terms of rates? There's really three plausible outcomes. I mean, it's not beyond the realms of possibility that they vote for rates to remain unchanged. We've got that all-important vote split. We've got guidance around the statement as well. And I do think it's sterling pairs that are likely to see the most volatility in the aftermath of all those three decisions.
Yeah, I absolutely agree with you. I'm going to be looking at euro sterling as one of my key pairs. I'm currently longing it a little bit from down below. I'm still waiting for a move up towards sort of 89 and towards 90. So yeah, pounds in focus.
Well, let's hold that thought on euro sterling, because that may be one of our plays of the day later on. Without further ado, let's get on to the matter of inflation, because it is a hot topic. It's been a hot topic in the market for a while, as we're all aware. But I think there's perhaps something that the market is ignoring at the moment, and that is the fact that although we're starting to see good news in terms of headline inflation, and we're seeing price pressures come down very, very nicely across the board. It's clear that headline CPI has peaked pretty much everywhere. It's the core figures that worry me, and I know this is something that we've touched on in the past. Core inflation, when you strip out food, when you strip out energy prices, is actually remarkably sticky. In the UK, we're continuing to see that accelerate to the upside. Core CPI printed 6.5%, I think it was, in December. In Europe, we're seeing core, or the expectation is that core CPI will remain unchanged at around 5.1, 5.2% this month when we get the data later this week. And in the States, core PCE remains almost double or just over double the Fed's target. And I think this is something that perhaps isn't getting enough attention, because if we do see these core price pressures remain elevated, and primarily one of the causes coming from this is obviously services inflation broadening out, but also the tightness that we're seeing in global labour markets, I do think this is going to give central banks reason, and all the reason they need to keep rates at their terminal level for much, much longer than the market is currently pricing in.
Yeah, I agree with you. It's the old second round effects, something the ECB talk about quite often. And you're right. We have to realise that the core lags the headline CPI number. I mean, you take the US case. Their CPI topped out just over 9% in June last year, and it's been down ever since. However, the core was still playing catch up, and even into the latter part of last year, CPI was coming down. The core was still rising. So there's always a bit of a lag between them. But the core does reflect what's happening on the ground. And there was a story I read this weekend about the Fed maybe getting worried about these second round effects, with employment numbers still being so strong, with wages still being on the strong side. Inflation comes down, wages start going up. It adds to that core inflation pressure. That may be something that they're going to take note of at the upcoming meeting.
Yeah, I would agree with that. And I think the other thing to bear in mind on that front is that, central bankers have almost been bitten by inflation once. They were obviously caught out after the pandemic. It's going to be transitory, it's going to be temporary, it's going to be short-lived. Well, those forecasts, as we all sadly are far too aware, did not age very well at all. So it's almost a case of, once bitten, twice shy. Whereas now that they seem to finally be getting that inflationary genie back into the bottle a little bit, the absolute last thing they're going to want to do is give even the slightest chance of price pressures becoming rampant once more. And I don't think that the market is pricing that in. If you look at interest rate curves, across G10, we see cuts priced late this year, early next. Equities are trading at very, very elevated valuations when you consider that rate cuts are unlikely. And I do think that we are likely to see perhaps a little bit of a wake-up call at some point soon. But that's probably enough about that. Let's have a look at China. I know you wanted to discuss that today.
Yeah, China, a potential big one coming in. They're back from the New Year celebrations, looking to open up. COVID is going in the rearview mirror like it is in a lot of countries here. So my thinking is, we have been trading a bit of China reopening, that story for the last couple of months. But now we get to see the super nuts of it, and we've got lessons to learn. We learned from other economies, from the UK, from America, from all around Europe, what happened when we came off lockdowns, came off the COVID wave, how economies rebounded very strongly, albeit temporarily, but there was a big, strong rebound. Now, that's obviously got repercussions for global growth, easing tensions with Australia, re-importing coal from Australia. These sort of things are going to open up, and it may just be a short-term effect in markets, but we saw Australia with higher inflation at the last print, a surprise. If China's now going to suddenly be a big player in the market, even if it's for the next 3 to 6 months, that's potentially going to bring some heavy inflation with it too. So the question really is, has the market priced enough to do with China, or has it priced too little, or has it priced too much? And question for you, will a bounce in China drag the global economy with it?
Well, I think it's an interesting one because the market has almost priced in all of the positives that are associated with the China reopening in terms of, the improvement in global growth, the easing of supply chains, all that jazz. What the market hasn't priced in is the fact that China reopening is going to be a massive tailwind to global economic demand, and primarily in the commodity space. You think about things like oil and copper and some of the other metals that are used significantly in the manufacturing sector. And of course, the more demand that you throw on top of a market which is already very, very tight in terms of supply, the commodity space in general, you get a bit of a perfect storm. And of course, that is going to send commodity prices higher. I think the entirety of the street is pretty much bullish on copper. Most people are bullish on crude, and a lot of people are bullish aluminium as well. And if you see those prices start to rise considerably, of course, one, it's a good trading opportunity for the speculators out there. But more importantly, from a macroeconomic point of view, that's inflationary. And that is another problem for the global economy, another supply side shock that the already very, very fragile global economy really can't be dealing with at the moment, can it?
No, exactly. That's the point I was hoping you're going to make.
It's almost like we practice this show, and it's almost like we know what we're talking about, isn't it? In that case, let's move on. Let's look at some charts. That's a setup. Comes next. Right, some charts. I've never understood why that police siren is there with that's a setup, but there we go. Let's get into the charts. That's what you're all here for. The first thing I want to look at this week is the 10-year Treasury yield. I have said for some time now, and I think the vast majority of seasoned market participants would agree with me, that the 10-year yield is the most important instrument you can look at if you're trying to look at what's going on in the markets. And that is even more true when we're moving into a week with a massive Fed meeting and two other key central bank decisions in it as well. Now, I certainly wouldn't advocate trading fixed income based on technical analysis, well, probably at any point, but least of all in a week such as this. But I think it's really interesting to note that the 10s are very, very delicately poised at this juncture. The market hasn't really wanted to move too far either side of 3.5% for a week or 10 days now. But I think going into this Fed meeting, we could see some really significant volatility in the bond market. If you see Powell really try to ram home this higher for longer message, really try to get the market to price out the cuts that it's got priced in for the back end of this year, then you're likely to see us move rapidly north of this 3.5% handle. And of course, that's going to be a tailwind for the dollar, and it's going to pose pretty stiff headwinds to stocks, particularly the tech names, which have driven the market higher so violently and so aggressively of late. And of course, on the flip side of that, if the market interprets the Fed as dovish, if the market thinks that the Fed are going to be looking to bring the tightening cycle to an end sooner rather than later, then does the 10-year yield look to take out the lows that we printed at 3.32% recently? So I don't know about you, Ryan, but I think 10s are really delicately poised. And if there's one asset I could watch over the Fed on Wednesday night, this would be it.
Yeah, no, I agree with you. 10s is always the go-to bond if you're looking at what's happening with the dollar and rates. And I think you're right. I struggle to see how it gains significantly. I can see it knee-jerking higher. I don't think it can hold the heights. The market is too far into its dovish bone, if you like, and any rallies in yields, I think we'll see them get hit. And I think 3.5%, if we run 3.8 to maybe 3.3, that I think is a good ballpark to run forward as we get through the further parts of the year.
Yeah, I would tend to agree with that. I mean, I think, just looking further out than the Fed, you've got inflation's peaked, growth is slowing, momentum's waning. It's tough to be bearish bonds at this point, particularly at the long end. But let's go all the way to the short end, because you want to look at the 1-year Treasury yield. Yeah,
the 1 year is very interesting for me. The reason being, it encapsulates obviously what's going to happen over the course of the year. We're in January, so it's a good way to look at things. Now, from this chart here, it's all about the ceiling, the Fed ceiling. They said they want to get rates to 5%, 5.25%. We've seen all the dots head up that way, but here we are with a yield, around about 4.7%. It's the market maybe underpricing what the Fed are trying to achieve. And I think here is where we need to look, as well as the 10-year, just to get that reaction in the dollar. Are we going to see a strong reaction in the dollar? If we can't get yields up towards that 5% mark and holding up towards that 5% mark, any short-term move in the dollar that follows yields up that high, you've got to think is not going to last. And then the market's going to settle back into its mojo, maybe drift back down to 4.8%. And as I say, this is the market saying, we don't think you're getting to your ceiling. And if you get in there, you're not going to stay there that long. They're already trying to trade out the market coming down. So for trading wise, that's what I'm looking for. I want a nice hawkish Fed. Obviously, I don't think they're going to be putting a rabbit out the hat hawkish wise. But if they stamp their foot down on these financial conditions and say we're going up there, if the market goes up there, I'm going to be looking to take advantage and potentially fade that move. What do you make of that?
No, I think you're absolutely spot on. I think the front end of the curve is really where the focus should be for answering the question of, does the market buy what the Fed is saying? And right now, as you can clearly see from that chart, no, the market doesn't buy what the Fed is saying, because if it did, the 1 year would be trading considerably north of 5%, because the Fed are saying we're going to get to 5 and we're going to hold at 5 for some considerable time to come. So as you rightly say, unless we do see a sell-off that takes us north of that 5% mark, then I do think it implies that the Fed have lost a significant degree of credibility in the market's view. It does imply imply that the market is not believing what policymakers are saying. And furthermore, it implies that any rallies that we see in the greenback are likely built on relatively shaky foundations as well, and should be sold into as a result.
Yeah.
Well, let's get away from fixed income and let's have a look at the S&P 500. I think we mentioned on the show last week, one of the differences between trade-off UK and trade-off Australia / Arizona is that we are going to look at things in a little bit of a longer term view, and we are going to revisit some of the charts that we post on a regular basis. And that's exactly what I'm doing this week. It's not me being lazy. It's purely an evolution of the view that we outlined last week, or at least that's the excuse I'm going to give my boss. In any case, we've seen the S&P 500 finally make a move north of this descending trend line that's been in place since, the start of 2022. I think it was the 6th or 7th attempt at trying to crack this nut that we've finally managed to break above that level. We've got a little bit of a golden cross trying to form as well, with a 50-day moving average beginning to cross above its 200-day moving average counterpart. And obviously from a purely technical view, although we failed to make a closing break of 4,100 on Friday, this would imply that the bulls have a semblance of control. But I don't know about you, I just really struggle to believe that this rally has legs. All the time, the market is still pricing in such a significant degree of cuts in the back end of this year. And all the time, the news on corporate earnings and on the economy as well continues to worsen. It's one thing saying the technicals look strong, but that's about all the bulls have got going for them at the moment, isn't it?
Well, I'm not so sure. You know, we are talking about this soft landing rhetoric with the Fed. Is that going to be good for stocks? Is that something that's going to see stock supporting? You know, the risk parameters that we spoke about last week and previously, is that changing the definition of risk? You know, bad news should be bad news for stocks, and we've sort of seen that through some of the data. But you know, there's two things in it. I think there's a lot of positivity in stocks that is coming from China. Chinese stocks have had a good run, but on a technical standpoint, you're right. You know, it's the old saying: if you knock at the door so many times, someone's going to let you in eventually. And this is what's happened here, this breakup. It got up to the next technical level, 4,100 on a lot of people's radars. That's where it's run into trouble. We've seen a pullback since. I think into the Fed, we're probably going to see a bit of range. I wouldn't be surprised if we're 4,000 bound in the short term. But again, what's it going to take from the Fed to move this significantly? And will it move significantly the right way? If the Fed isn't as hawkish as the market expects, if they're a bit dovish, in theory, stocks should tank. But if they go the other way, then that's going to tell us a different story altogether.
Well, it will do indeed. And maybe I'll even revisit that chart for a third week next week, depending on what the Fed do. See if I can get away with that. Let's have a look at something fresh. Let's have a look at, admittedly, something I haven't been paying particularly close attention to lately, which is crude.
Yeah, this is one I'm looking at. And again, it's a bit of a play on the China situation as well, because we're talking about commodities, China coming back to the table, you know, a big bounce in their economy. You know, what are we going to see from oil? There's two things at play here as well. We've also got Biden, you know, restocking up the SPR, which I think we saw that's part of the market move we saw at the beginning of the year. But here we've got a bit of a technical situation where we're banging our head against an old fib up at the 82.50 area. And we've got a bit of a low coming in now, a bit of a floor building down around the sort of 78, 77.5 area. So I want to see this early week in China, if they're coming back to the market, are they going to be buyers of oil? Are they going to come steaming in and soaking up some commodities, you know, getting back on track? They've had a good holiday, apparently, good for the economy, lots of spending. I think oil imports are up 12.2% or something, energy imports 12.2%.
Someone's done their homework, haven't they?
Oh, always need to do your homework. Always need to do your homework. I'm good at Googling, I'll tell you that. So, yeah, it took a bit of a knock on Friday. I wasn't sure what was totally behind that move, and I did try a little bit of knife catching Friday afternoon. I'm still in that a little bit at the moment. But, you know, we need to see what happens here. And I think if we can break that 82.50 highs, and if that's led by a buying from the Chinese side, or at least the market on hopes that, you know, they're going to recover strongly and manufacturing is going to increase, then I think this might be one to watch for the upside as well.
No, I would agree with that. I think it's certainly one that's worth keeping a close eye on. The reason why it's been a little bit discounted in my mind of late is simply because of how sort of flippant and volatile sentiment has been regarding China. You know, one week it's they're reopening and all is fine and dandy, and the next it's, oh, maybe there's a few bumps in the road, and obviously we come all the way back lower again. But if we do start to get a little bit of clarity on that, then that is obviously going to be important, not just for traders who are long crude, but also, as we alluded to earlier, for the global economy more broadly. You know, if we start to see oil prices move higher, then that's obviously inflationary. But not only that, do you then start to look at that in the FX space as well? And we look at currencies like the Canadian dollar and the Norwegian kroner, which also might start to outperform. And actually, the Canadian dollar, just touching on that, it's been remarkably resilient lately. We've had, I think, 5 straight weeks of gains for the loonie against the greenback, and that's despite the Bank of Canada bringing their tightening cycle to an end, and crude prices being range bound to marginally negative. And I think that perhaps does bode, if we do see a move higher in crude, that might bode well for the Canadian dollar as a result. But that might be an idea for next week. Let's have a look at some actionable ideas for this week in the play of the day. So I'll kick things off, and Ryan mentioned this earlier with regards to euro sterling, and I fear I may have stolen his trade idea, but then again, I was up filling our run sheet in at 4 o'clock this morning, so I feel like I'm justified with that theft. You've got some levels marked out on the chart there, but for me, this is more of a macro and a fundamental trade, and simply a way of expressing a view on diverging economies and diverging central banks than it is any sort of technical pattern. It pains me to be long euro sterling. I've never been a huge fan of the euro, and obviously I'm slightly biased towards the pound, given that we're here in London. But nevertheless, there's 2 really key divergences here. We've got a really determined hiker in the ECB being pit against a really reluctant hiker looking for any excuse to bring the tightening cycle to the end in the Bank of England. One wants to continue hikes through to May or even June. One wants to get things wrapped up pretty much as soon as possible, possibly even as soon as February. And then, of course, on top of that, you've got the fact that the Eurozone economy is very, very resilient indeed and has staved off a winter recession, while the UK economy seems like it's stalling and barely getting out of first gear, and we could have a recession this year that lasts 3, 4, maybe even 5 quarters if it runs into 2024. But I might be getting a little bit pessimistic there. So personally, long euro sterling, I think in the short term, will relatively easily get back to this 89 level, probably a move towards 90 in the slightly longer term. Obviously, the risks with this are that the BoE are a little bit more hawkish than we expect, that the ECB ease up on the economic brake pedal, or that the data starts to converge a little bit more. But at the moment, I think long euro sterling is certainly my play of the day. So what are you going with this week, Ryan?
Yep, I'm going with Aussie dollar. Interesting technicals showing up on this one. Again, another pair I'm actively in. I've been long this one since last October, and it's looking interesting. As I say, on the technical standpoint, we've hit our head up at this 71 handle, up at the zone I've got, sort of 71, sort of 30, 40, and there's another one a bit further up. And while you've got these marked highs, it gives you something to lean on. The market's saying we're not going past here for the moment. On the downside, we've got a bit of a break level around the 70, 60, 70 level. This, again, is something I traded last week on longs, offloading above 71. So there's a couple of ways to trade it here. Trade shorts, I think, up into that 71 area, up towards those highs again, particularly before the central bank meetings. I wouldn't want to be doing too much new over these meetings. But shorts up towards those highs there. And this 70, 70, 60 area, they could be worth looking at for longs, because you know you can keep your risks really tight. If you get a break below 60, maybe below 50, we're probably heading down towards the low 70s. So if you want to flip a trade on this one on the short side, if we break under 50, maybe looking to see if we get another test of the broken 60, 70 area, then get yourself into a short and maybe look for something down towards the 70 area.
Good stuff. Thank you very much, mate. Well, with that, it brings us to the end of another show and the start of what is going to be a very volatile, very busy, very, very hectic week in the financial markets. I think we'll all be ready for one or maybe more very cold beers by the time Friday afternoon comes around. Such is the week that likely lies ahead. Hopefully, Ryan and I have managed to give you a little bit of a steer and a little bit of an idea on what may pan out and how you may be able to trade as we go through the next few days. Of course, we will be back next week, probably to review the carnage that lies before us after the central bank meetings, the earnings, which we haven't even had time to touch on, and the busy economic calendar have all panned out. So all that's left for me to do is to say thank you to Ryan for joining me, as always, and also to say thank you to the man without whom none of this would happen, Kyriakos, our producer. Thank you to him as well. All three of us will be back this time next week. Thanks as always for watching, and goodbye for now.